Yes, good evening, class. Welcome to our today's session. So I think we can continue with our revision, and I hope you are also revising from your side. You are working extremely hard. Take into account you have, I think, like 1 week or less than 1 week for you to sit for this paper, and therefore I hope you are working extremely hard. Now, I think we had agreed that once we meet today, we can try to look on a number of topics. Those small topics, that is the financial instruments. I think we did a question on leases. There is another question which I have here for leases. Maybe equally, I think we can look on it, and then we see what next. So let's start with that small question on leases, and then from there we look on something else. So this is a question, I think, from another paper, not specifically from your paper, not from your paper. That is a paper for a 𝗟𝗏. So let's look on this question here. Let me share the same in the class WhatsApp group. Yes, already shared. So check in the class WhatsApp group. Check in the class WhatsApp group. So once you get the question, please confirm. Once you get the question, you confirm. I've shared that question in the class WhatsApp group. Yes. Okay, confirmed by Rin there. So let's look on that question. It's basically a question on leases. A question on leases. So what are we told here? What are we told here? Yes, so the question is that on the 1st of December 2020, 𝗟𝗃 Limited entered into a contract to lease an item of machine from supplier for 4 years. So the terms of the lease were that 𝗟𝗃 Limited was required to pay annual rent of 1.55 million in arrears, commencing that year of November 2021. Initial direct costs incurred on the lease amounted to 429,570 and were paid by 𝗟𝗃 Limited. So the machine had a remaining economic useful life of 6 years at the commencement of the lease, and then you're told the lease did not contain any purchase option for the lessee. Did not contain any purchase option for the lessee. And then you're told the interest rate implicit in the lease was 13% per annum. And then you're told the present value interest factor of annuity 𝗶𝗶𝘃 at the rate of 13% for 4 years is 2.97447. So what are we required to do here? We're required to analyze the accounting treatment of the above list transaction in the financial statements of 𝗟𝗃 Limited, for the year which ended 30th of November 2021 or the year 2024. So basically, these are a very good question on leases. These are questions are borrowed from another paper, called FSA, Financial Statement Analysis. This is a paper which is done in 𝗟𝗏. And basically, this was a question from April of 2025, specifically question number 5B. Now, in this case, we are told that this company, which is called 𝗟𝗃 Limited, entered into a lease, and this company, 𝗟𝗃 Limited, leased an item of machine from a supplier. So automatically, 𝗟𝗃 Limited is the lessee, is the company which was given the right to use an asset, whereas now the supplier is the owner of the asset. So if you go to the requirement, you're required to analyze the accounting treatment of the above this transaction in the financial statement of who? Of 𝗟𝗃. So in other terms, you're required to illustrate how 𝗟𝗃 Limited, who is the lessee, was supposed to account for this particular risk. And remember what we said is that once a company leases an asset, so that company should recognize 2 items. There is liability, the right of use asset. But remember, we also talked about 2 exceptions in relation to that. You may come across that theory questions, theory question whereby you are asked to give two instances whereby the lessee will not be required to recognize the lease liability and also the right of use what asset. So we talked about two circumstances. Number one, we talked about a short-term lease. If you lease an asset for a short period of time, a period which is less than 1 year, you are not required to recognize the lease liability and the right of use asset. Number one is therefore where the lease is a short-term lease. Number two is whereby the leased asset is of a low value. If you lease an asset which is regarded to be of a low value, you are not required to recognize the lease liability and the right of use what asset. But this company, Pen Limited, basically on the date the lease commenced, the company needed to recognize two items: the lease liability and the right of use what asset. We said always we start by computing the lease liability. We start by computing the lease liability, and basically we compute this on the date when the lease commenced. In other terms, we compute this on the inception date of the lease. So if you go back to the information we have in the first paragraph, the first sentence, this lease was entered into on 1st of December 2020. That is when this company, Pen Limited, leased that particular item of machine. So we need to compute the lease liability. How do we compute this lease liability? We say that this one is equal to the present value of the minimum lease rentals not paid at the inception date. Not paid at the inception date of the lease. Inception date of the lease. Not paid at the inception date of the lease. So we discount those particular minimum lease rentals, but which were not paid at the inception date. So basically, if we go back to the information still which we have in paragraph 1, we are told that this company leased an item of machine for a period of how many years? For a period of how many years? Are we given? Yes, for a period of 4 years. I hope you can see that in the first sentence. So this therefore is the lease for how many years? Is the lease for 4 years. Year 1, year 2, year 3, year what? Year 4. So how are the minimum lease rentals payable? As per the information we have in sentence number 2, we are told the terms of the lease were that Pen Limited was required to pay annual lease rentals or annual rentals of 1.55 million in arrears. In arrears means what? At the start or basically at the start or at the end of the year. Who can tell us? In arrears means what? At the start or at the end? At the start or basically at the end? Yes. In arrears means at the end. So this amount was payable at the end. So the amount which was supposed to be paid at the end of year 1 is 1.55 million, 1.55 million. At the end of year 2, at the end of year 3, 1.55 million, 1.55 million. And therefore, if you check this particular question which you are doing here, you should be able to note that it is different from the other question which we did. I hope you can remember the other question which we did in class the other day, a question which was examined in December 2024. So remember the lease rentals, the minimum lease rentals were payable at the start. So therefore, I want you to see the difference. Rin, I think there was a question which was asked by Rin. There was a question which was asked by Evans. So in terms of the difference, whenever the minimum lease rentals is payable at the start and also at the end, we say there is a difference in terms of how we compute the lease liability. Number 2, how we prepare the lease amortization schedule. Remember, therefore, all these particular amounts are payable at the end. So how do we compute the lease liability? We discount the minimum lease rentals not paid at the inception date. Now, this amount, all of them, you can see they were not paid at the inception date because there is no amount which was paid there. Because we said we discount everything excluding the amount paid at the inception date. So we will take 1.55 million. We multiply this with the present value interest factor of annuity at which rate? At the rate of 13%. At the rate of 13%. The rate of 13%. Then what will be our N here? Our N will be 1, 2, 3, 4. So we are discounting minimum lease rentals for how many years? For 4 years. Yes. So for 4 years. But remember, if this particular amount were payable in advance, so for example, this amount was paid here at the start of year 1. This was paid at the start of year 2. This was paid at the start of year 3. And this one was paid at the start of year 4. What would be the difference? The difference would be our N here. Our N should be 3. Our N should be 3 because we just need to discount what was paid there, and there. So the amount paid at the inception date should not be discounted. Yes. So let's work out this. And I think in our case, we already have this value. we already have this value. Remember, we said in case the examiner has not given you this is the formula you have to recall. 1 minus 1 plus r raised to power negative n, we divide that with r. So that is the formula you need to remember. But I think in our case, we already have this value here. In the last paragraph, you told the present value interest factor of annuity at 13% for 4 years. This one is given as what? This one is given as 2.97447. So if you work out this using this particular formula, you have 1 minus 1 plus r. Remember, our r is 13% raised to power negative n, that is 4. And then you divide that with 0.13. You should get that value there. You should get that value there. That's yes, we multiply that with 15, 50. So what would be our risk liability here? What would be our risk liability? What would be our risk liability? We try to hurry up so that we do at least more questions. What are you getting? So I'm getting a value of 4610,428.5. Yes, so basically that is the value I'm getting. Yes, I think we can work with that figure right now. Yes, so that basically would be the risk liability. Now we said, even before you move to compute the right of use asset, what do we need to do with this risk liability? We need to amortize it. Before we proceed to compute the right of use asset, can we amortize this? So let's amortize this by basically preparing the risk amortization schedule. There is amortization schedule. There is amortization schedule. So you'll also be able to see that there is difference in terms of how we're going to prepare this with what we did in the other question, simply because these minimum risk rentals are payable at the end. So take into account our risk is basically for 4 years. We need to have 4 years here, or you can have the specific dates when those 4 years were ending. So those specific dates are given in the requirement. If you go to the requirement, so you'll be able to see that you're given those specific dates. The first year ended 30th of November, 2021, 30th of November, 2022, 30th of November, 2023, and 30th of November, 2024. So then the next column here should be for the risk liability at the start of the year. The next column will actually be for the interest. The next column will be for the interest, and this one we computed at the rate of 13%. But remember, if these minimum risk rentals were payable in advance, so after the risk liability, the next column should be forward for the cash paid, for the minimum risk rentals paid, if this one was payable at the start. Yes, but because it is payable at the end, so the next column should be for the interest. The next column should be for the minimum risk rentals, paid. And finally, we have the risk liability at the end of the year. So that's basically how we arrange our risk, the risk amortization schedule. And therefore, you can see always we interchange these two columns, depending with when the minimum risk rentals is payable. Can you be able to see that difference with what we are doing here and the other question which we did in class? Rin, can you be able to see the difference? Evans, can you be able to see the difference? Yes, I want you to see that difference. There is always a difference in terms of how we compute this one. There is the risk liability, and actually how we do what we present this. So in case the minimum risk rentals is payable at the end, so after the risk liability at the start, what comes next is the interest, and then the minimum risk liability. Yes. So what we start with here is basically the risk liability at the start of year one, and that is basically what you have computed there, which is basically an amount of 4610 for 28.5. So we compute interest, which will be 13% of this, 13% of the opening balance, 13% of this, and basically I'm getting 599, 356 to the nearest whole number. Let's work with that to the nearest whole number. And then the minimum risk rentals, which was paid at the end of year one, is this one, 1550,000. So this one we said it reduces the value of the liability. So to compute the risk liability at the end of year one, we will take this one, risk liability at the start of year 1, we add the interest, we minus this. So in other terms, to compute this, we are taking what? In other terms, to compute the risk liability at the end, we are taking this one, the risk liability at the start, we are adding this one, the interest paid, we are raising the minimum risk rentals paid. So we are taking A plus B minus what? Minus C. Minus what? Minus C. That's basically how we are getting that value there. Sasa? Yes. So let's work out that. So we add 4610, 428.5 minus 1550. Yes. And basically here I'm getting what? I'm getting 36, 59, 784, 784.5, or let's just work with this to the nearest whole number. Let's just work with that to the nearest whole number. 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 This one should be 9. Eh? Let's work with that. It's 9. To the nearest whole number, it should be that. Eh? Yes. So that will be the opening balance here. 3659. 3659, 785. So we compute interest, which is the 13%. 13%. Basically, I'm getting 475. 772. So the amount which was paid at the end of year 2 is this one, which is 1550,000. And then we compute the risk liability at the end of year 2. So we have 36, 59, 785 plus the interest 475, 772 minus 1550. Yes. And what are you getting here? My figure automatically is not correct here. Yes, what are you getting? Yes, 25, 85, 557. Eh? Yes, so that will be the opening balance here. 25, 85, 557. So we compute the interest as 13%, which will give us 336, 122. The amount paid is 1550,000. Yes. So let's work out the risk liability at the end of year 3. We have 25, 85, 557 minus 155. Yes. And basically here I'm getting 13, 71, 679. 679. I hope that is what you're getting. So that will be the opening balance here. Is the opening balance here. And then we compute the interest as 13%. 13%, and basically I'm getting 178,318. So the amount paid there is 1550,000. And automatically this one should give a 0 or a figure which is insignificant. So let's see what we have. 178,318. Yes, 1371, 679 plus 178,318. Yes, so I hope you can see this coming for around 3, but essentially it should be 0. Should be 0. The reason why you're not getting 0 is because of rounding off. So therefore, that's basically how we prepare that particular risk amortization schedule, basically to amortize our risk liability. Having this 10, we need to move and basically we compute the right of use asset. The right of use assets, and basically the right of use asset, equally we compute this at the inception date of the risk. Remember, the risk commenced on 1st of, this one should be December. It should be December, 1st December of 2020. That is when we are computing the right of use asset. Now to compute the right of use asset, we said we add like three values. Number one, we take the risk liability. There is liability at the inception date, and basically that is the inception date is 1st December 2020. So, and there is liability at the inception date is what you have computed here, 4610, 429. To this we said we add any payment made at the inception date, of the lease. Do we have any payment which was made here at the inception date of the lease? In our case, we don't have any payment which was made at the inception date. We say that you can only have that payment which was made at the inception date, whereby these minimum lease rentals are payable in advance. So if it is payable in advance, automatically the amount was supposed to be paid at the start, at the inception date of the lease. And then to this we add what? Initial direct costs, which are associated with what? With the lease. The initial direct costs associated with the lease. And I think in this question here, we have some initial direct costs which are associated with the lease. Can you see that? Initial direct costs associated with the lease. Who can be able to see that value? It is within paragraph 1, the last sentence. Can you be able to see this? Abdinasil? Amos, can you be able to see that? Yes. Yes. So the initial direct cost associated with the lease is 429, 570. So we add those two values and we get now something called the rate of use asset. The rate of use asset. So the rate of use asset will be 4610, 429 plus 429, 570. And basically we get what here? We get 15. Okay, I think we can work with this one as 0.85, though you can't be penalized for that. So that will give us 50, 39, 998.5. Is that what you're getting? Is that what you're getting? 50, 39, 998.5. Yes. So having that, then, the next thing we need to do is basically to compute the depreciation per annum. Remember, we say that this rate of use asset should be depreciated on a straight line basis at the shorter of two periods. At the shorter of two periods, number one, the lease term. The lease term basically is the period of the lease. In our case, we know this is the lease for 4 years. And number two, the remaining useful life of the asset, or the remaining economic life of the asset. So we're given that in paragraph 2, we are told the machine had a remaining useful life of 6 years. 6 years. So out of the two period, we take the shorter of the, or actually we take the period which is shorter, which is basically 4 years. So we will depreciate this on straight line basis for 4 years. So to compute the depreciation per annum, we will take the rate of use asset 50, 39,998.5. We divide that with 4. We divide that with what? We divide that with 4. So we have 50, 39,998.5 divided by 4. And basically this will give us depreciation of 12,559. 1259 to the nearest whole number. To the nearest whole number, I think should be 1260. Is it 1260? Yes, 12,560,000. To the nearest whole number. To the nearest what? To the nearest whole number. To the nearest whole number. To the nearest whole number. Yes. Now, that basically what was required. But if you check on what the question is requiring, we require to analyze the accounting treatment of this in the financial statement. We said, in such a case, what you need to do is you prepare financial statement extract. You prepare the income statement extract. You show what was supposed to be recognized there in relation to this risk. So we start by preparing the income statement extract. We start by preparing income statement extract. And remember, you say that in the income statement extract, what the company is supposed to recognize, 2 items. One, we have these interest. And actually, we say that this interest should be recognized as part of the finance cost. Number 2, the company should recognize this particular depreciation. So, and actually, we are going to prepare this for these 4 years here. The first year added that year's November 2021, that year's November 2022, that year's November 2023, that year's November 2024, like that. 4 years. So at the expenses, our company will recognize 2 items. other expenses. So we have these interest. You can just refer to it as interest, or you can just include it here as part of the finance cost, because that will be a finance cost. So this will be the interest for the first year, 599, 356. So for year 2 is this one, 475, 772. For year 3 is 336, 122. And basically this one is 178, 312, 318. Yes, the other item which will also be recognized here is basically the depreciation on the right of use asset. The depreciation on the right of use asset, whatever you have here, this one. And basically this one remain the same for 4 years. 1256,000, 1256,000 fair, 1256,000 fair. Yes, so that is basically what our company here was supposed to recognize in the income statement as far as this is what is concerned. So these are basically the values which will be marked. Remember, we have said whatever, or actually we said whatever you have done here, all these are workings. What earned you the marks is what you have here. Sasa? Yes. So therefore, you must ensure that you have prepared these financial statements extracts. So then from there, we can prepare the statement of financial position, statement of financial position extract. Statement of financial position extract. 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 Equally, we will prepare these basically for 4 years. That year, the November 2021. That year, the November 2022. That year, the November 2023. That year, the November 2024. 2024, like that. Now, here in the statement of financial position, how many items will be recognized here? 3 items. One of it, David, automatically the figure which you have in the 1250. Oh, that will give us what? 1260. The 1260, yeah? To the nearest whole number, David. It's up to 1260. Is that the position? Yes, I think this one should be 1260. Huh? It should be 1260. Like that. I think that should be the correct value. Is that the case? 1260? Yes, 1260. I think it is our rounding off, which is basically along here. But basically should be 1260. 1260, yeah? Yes, 1260 like that. Yes. So basically 3 items to be recognized here. One of which is the right of use asset. Now the right of use asset, that one we recognize it as part of the non-current assets. So under the non-current assets, we will have the right of use assets. The right of use asset. Now the right of use asset, we recognize it here at the net book value. So to compute the net book value for the right of use asset, we will take the cost, this one, and then we less depreciation for year 1. When it comes to year 2, we take this one minus depreciation for how many years? For year 2. For what? For year 2. No, you don't need to show that as provided you have recorded that as expenses. RIN, the person who is marking that will be in a position to see that those are expenses, provided they are other expenses, because these are an extract. That's an extract. Yes, let's compute the right of use asset, the net book value. So we take the cost, which is 50, 39,998.5, and then we minus the depreciation for the first year. This is the depreciation for the first year, which is 1260 x part 4. And basically that will give us what? Will give us will give us 37, 79, 99. Okay, to the nearest number, it will give us something like that. So then year 2, we also less the same. In year 2, you can take this minus that depreciation. Are we together? Yes. So we take, alternatively, you take this minus depreciation for 2 years. But the easy approach is once you have computed the net book value for year 1, to get the net book value for year 2, you take the net book value at the end of year 2, at the end of year 1, sorry, you less the depreciation for year 2. Sasa? Yes, so we will take this, we less depreciation for year 2, which is 1260 x part 4. And basically that will give us 25, 19, 999. What about there? So we take that value, we less depreciation for year 3, which is 1260. And that will give us a 1260,000. And then here, the net book value will automatically be 0 because it is this minus that. So that's how we compute the value for the right of use asset. Then from there, we said that this particular lease liability, this one should be recognized in the statement of financial position as a liability. But basically, we said this amount has to be split into two. Part of it will be recognized here as an non-current liability. So under the non-current liability, we will have the lease liability, and still under the current liability, under the current liabilities, we will also have what? The lease liability. We will also have the lease liability. I think I showed you how to split that, how to determine the amount to be recognized under the non-current and also under the current. We said, I think whatever is very simple is first of all to determine the amount to be recognized under the non-current liabilities there. Under the non-current liabilities there. So we said the amount to be recognized as a non-current liability at the end of year 1, that is this year, we take the lease liability at the end of year 2. So the amount to be recognized as a non-current liability in year 2, we take the lease liability at the end of year 3. At the end of year 3, we take the lease liability at the end of year 4. At the end of year 4, the lease liability at the end of year 5. So therefore, in year 1, the first year here, the amount to be recognized as an non-current liability is this one. So which is 25,85,557. In year 2 is what we have here, 13,71,679. In year 3 is basically 0, and also in year 4 is 0, like that. Yes. Then from there, to determine the amount to be recognized as a current liability, we say this amount payable within 1 year. And therefore, we said we take the decrease, because the decrease basically is the amount which has been paid. The reason why liability reduces is because there was a payment which was made. There was a payment which was made. So let's get the difference here between these two values here. We have 36, 59, 785 minus 25, 85, 557. And basically we have a decrease of 10, 74, 228. I hope that is what you're getting. David, the writer, is that what you're getting as the decrease, as the difference between those two values? Is that what you're getting? Yes. So then we move to year 2. Year 2, basically we get the difference between these two values here. The difference between those two values there. That is the 25, 85, 557, 25, 85, 557, and this one, minus 13, 71, 679. So and basically that will give us an amount of 12, 13, 878. Yes. And then now in year 3, we get the difference between this. Remember, the lease liability there is 0. So the difference between those two values there is what? Is 13, 71, 679. And automatically in the last year, the lease liability is what? Is 0. And the lease liability there is 0. The lease liability there is what? Is 0. Is what? Is 0. So that is it. That what was required in that question. So what will earn you the 8 marks is basically what we have here. But remember, there is a similar question which we did in your paper 6. That question, the marks allocated there were 10. So meaning that in such a question, you can either be given 8 marks or basically 10 marks. But what I want you to understand is the difference in terms of how we compute the lease liability, how we compute the right of use asset, how we prepare this particular lease amortization schedule whenever the minimum lease rentals are payable at the start of the year and also at the end, because that is the question you're likely to come across. The minimum lease rentals are payable either in advance or in arrears. You must be in a position to compute the lease liability, to prepare this one, and the right of use asset. Yes. So basically that is it. That what was required as far as that question is concerned. And therefore, I hope that if you happen to come across a question from this topic, the topic of leases, I expect you to score good marks as far as that question is concerned, because I think we have revised from this. Maybe what you also need to do is, can you try to check on how the leases are accounted for by the owner of the asset? The owner of the asset, or basically the lessor. Try to remind yourself how that particular person accounts for the leases. Account for the leases. Account for what? For the leases. Account for what? For the leases. Okay. So we have that. We have another small question here. Basically, I want us we switch now to another topic, a topic of financial instruments. So remember, in relation to that topic of financial instrument, we did a number of we covered a number of concepts. The first concept we did was on compound financial instruments. Compound financial instrument. And remember, I say that compound financial instruments are the financial instruments issued by the company. They contain both equity and liability component. And actually, we say once the company has issued a compound financial instrument, as per the requirement of or as per IAS 32, the company should split the two components. The company should split the liability component and the equity component. There is equally a question here I want us we go through. Let me share the same. But there is a similar question which we did in class, which is the same with this. Yes, equally, I've shared that question in the class WhatsApp group. I've shared that question in the class WhatsApp group. I hope it is clear. I hope it is clear. Is it clear? Whatever I've shared in the class WhatsApp group. Is that question clear? Yes, I hope it is. I hope it is. I hope it is. But before we look on that, can we just take a short break of just like 8 minutes? We come back at 9:10, so that we continue with that question. So we just take a short break of 8 minutes, and then we come back up after that short break of 8 minutes. We come back at 9:10. Yes, so I want us to continue. I hope you're back. I hope you're back. So let's look on these that questions here. Let's look on that particular questions here. So the question reads, that Good Limited issued 𝗟𝗶 7% convertible bonds on 1st January 2019 par value. So the bond is redeemable at par on 31st of December 2023, or can be converted at that date on the basis of 2 shillings 1 ordinary share for shillings 10 of the bond held. So we are told the prevailing market rate on 1st January 2019 for similar bonds without conversion rights was 9% per annum. And then you're told that all the interest in the year to 31st of December 2019 has been paid. So what are we required to do here? We are required to calculate the amount being included in the statement of financial position of Good Limited in respect of the convertible bonds on 31st of December 2019. So now we say that if you happen to come across this question and you see the word convertible, if, for example, you're told a company issued a debt instrument, and that debt instrument issued by the company happens to be convertible, then we say what you need to remember very fast is that this is a compound financial instrument. This is a compound financial instrument. Remember, I said a compound financial instrument. We said that this is a hybrid financial instrument. In fact, in other terms, it can be referred as a hybrid financial instrument. It's a financial instrument which contains both equity component and the liability component. It contains the equity and the liability component. And we say once the company has issued such a compound financial instrument, As per IAS 32, the company needs to split the two components, the liability component and the equity component. We look from the steps to be followed. First of all, we said we compute the liability component. Number two, we compute the liability what? A component. So what I want us to do, let's go straight to that question. We go straight to that question. Equally, this is a question I've borrowed from the paper for 𝗟𝗲, financial statement analysis. So this, I think, was from which sitting of 𝗟𝗲? This one from the sitting of November 2020. And this specifically was question number 5A. Question 5A. So we are told this company, which is called Good Limited, our company did what? Issued. The company issued 7% convertible bonds. So take into account, we have the word convertible. I'll say that this one is a compound financial instrument. Yes. So therefore, that is very important. That if you happen to come across maybe a question and you're told a company issued some debt instruments and which are convertible, like convertible bonds, convertible loan stock, convertible debentures, you need to remember that that is a compound financial instrument. So therefore, this we can say this is a compound financial instrument and should be accounted for. In accordance with what? In accordance with International Accounting Standard number 32. Remember, I said this standard, International Accounting Standard number 32, basically requires that once a company has issued a compound financial instrument, the company should split the two components, the liability component and the equity component. So the first thing we do is to compute the liability component, and then from there we proceed and we compute the liability component. So therefore, step one is basically to compute the liability component. The liability component. And actually, we compute this liability component on the date of the issue. When were these convertible bonds issued? We are told in the first paragraph they were issued on 1st of January 2019. 1st January 2019. 1st January 2019. So we say that this liability component is equal to the present value of the annual interest, the present value of the annual interest plus the present value of the principal payment. And actually, you cover similar concept in FM. For example, like when computing the value of debentures, the value of the other debt instrument. Usually, this is a concept you use. You discount the interest to be paid on annual basis and also the principal amount. These basically no much difference with what you do in financial management. Whenever you're required to compute the value of maybe a debenture, the value of a bond, I think it's basically what you do. So what we need to do here is first of all, we compute this one, the annual interest. So we say the annual interest, in other terms, the interest per annum. How do we compute this? We say the formula is very important because we say that in these questions, you'll be given two rates. You'll be given two interest rates. Which interest rate do we use? We use this one, the coupon interest rate. The coupon interest rate, we say, is the interest name coming before the name of the compound financial instrument. Like the compound interest rate is 7%, and then you multiply that with the par, the face, or in other terms, the nominal value of what? Of the compound financial instrument. So therefore, in our case here, the coupon interest rate, I've said is the interest rate which is given before the name of our CFI, which is 7%. And then still in the first paragraph, the first sentence, we're told the Good Limited issued shillings 4 million, 7% convertible bonds on 1st January 2019 par value. So meaning that 4 million is the par value. 4 million is the par value. Remember, this par value can also be known as the face value, can also be known as the nominal value. The examiner may use any of the words here. Yes. So this will give us shillings 280 million. And remember, this will be paid per annum. This one will be paid per annum. So we already have this. So then from there, we need to determine the principal the principal amount. In this case, we say the principal amount. This is the amount payable on redemption. So once these particular convertible bonds mature, how much amount will be paid on redemption? So that information, we have it within first paragraph, the second sentence. We are told the bond is redeemable at par. That is very clear. The amount to be paid on redemption, this one is equal to the par value. So in our case, remember, we know the par value is how much? Is 4 million. So this is the amount to be paid on redemption, and we must be given the date when they will be maturing. So these convertible bonds, they have a life of how many years? So we are told they will be redeemed at par on 31st of December 2023. So that is the redemption date, and basically that will help us in terms of knowing the life of these convertible bonds. Remember, they were issued on this date. 1st January 2019, we are told they will be redeemed on 31st of December 2023. How many years do we have here between those two dates, between the dates they were issued and the redemption date? How many years do we have there? How many years do we have there? We have the first year, which will end 2019, and 31st of December 2019, 2020, 2021, 2022, 2023. 1, 2, 3, 4, 5. Yes. 2019, 2020, 2021, 2022, 2023. And those 5 years all four. They were issued on 1st January 2019. Are they 4 or 5 years? Remember, in this case, the year is supposed to end on 31st of December. Kuna 2019, 2020, 2021, 2022, 2023. Those are 5 years. So the life of these bonds in 5 years. And remember, in this case, we said when computing this liability component, we assume that the holders will not convert them into ordinary shares. I think we say that is an assumption which we make. That's why you check on that question. There is somewhere we're given information about how they can be converted into ordinary shares. There is no way we use that information here, because we say for us to be able to compute the liability component, we assume they will not be converted into ordinary shares. That's why that information about the conversion, we don't use it here. So we say to discount this, there are two approaches you can use. Remember, this company here, which issued these bonds, which have a life of 5 years, the life of 5 years, our company is expected to pay this amount per annum. To 𝗟𝗃 will be paid at the end of each year. And automatically, this interest is always payable in arrears. This one is payable in arrears. That is the amount to be paid per annum. That is an annuity. And then at the end of year 5 here, the company will also pay this amount of 4 million. So we said to discount, you can either prepare, for example, a table here from year 1 all the way to year 5, and then you have this amount to be paid. Here you have to 80,000, year 2 to 80, year 3 to 80, year 4 to 80, but year 5, we will have to 80,000 plus 4 million. And then you discount this by multiplying that with the present value, interest factor, and which rate do we use in discounting? When discounting, do we use this 7%? No. In discounting, we say we use another rate, which is known as the effective interest rate or the market interest rate. And I hope you can see that within the last paragraph. We are given the prevailing market interest rate of 9%. So at the rate of 9%, you get those values, you multiply this with this, you get the present values. Alternatively, we said, because this is the 280 is an annuity, so to discount that to 80, we will take 280. We multiply that with the present value interest factor of annuity at the rate of 9%, and basically for 5 years. For 5 years, then this 4 million, these are lump sum which will be paid basically at the end of year 5. So we multiply that with the present value interest factor at the rate of 9% and basically for 5 years. Remember the formula for getting 𝗶𝘵, and this one is different. So here we have 280. So the formula for getting this is what? 1 minus 1 plus R, which is 1.09, raised to power negative 5. We divide that with R 0.09. That is how we compute that 𝗶𝘵. And then we add this 4 million. So the formula for getting this is 1 plus R, which is 1.09, raised to power negative 5 by such. Yes. So let's work out this. we start with what we have here, the 𝗞𝗏. So we have 1.09 raised to power negative 5. So 1 minus answer divided by 0.09. That will give us 3.89. Okay, we can, I think we multiply that directly with 2.28,000. And this will give us 1089 102 102. That is basically what I'm getting here. What about this one? 1.09 raised to power negative 5. Is that correct? Can you confirm whether you get that? Yes, so raised to power negative 5 times 4 million. And basically that will give us 25.99 726. 726. Yes, so we add the two values. And I'm getting a value here of 36. 828. That is basically the value I'm getting here. You can confirm whether you're getting the same. Confirm whether you're getting the same. Are you getting the same? Yes, are you getting the same? Are you getting the same? Yes. So that is the what? That is basically the liability component. The liability component. Now, having computed that liability component, step number 2 is to compute something called the equity component. The equity component. And actually, we also compute the equity component on the same date, 1st January of 2019. How do we compute this equity component? We take the cash proceeds. Cash proceeds, remember, we say that is the amount of money which was received. Once the company issued these particular convertible bonds, how much amount did our company receive? That information, we have it within paragraph 1. We told the company Good Limited issued shillings 4 million, 7% bonds at par. They were issued at par. The par value is 4 million. The par value is 4 million. So the amount which was received by our company was 4 million because we are told they were issued at par. They were issued at par. So we take that, and then to this we less what? We less the liability component. The liability component on the same date, 1st of January 2019. And that is now what you have computed here. This value here, 36, 88, 828. 828. So the difference here will be what? The difference here will be the equity component. Equity component on 1st January 2019. So, and that will give us 311, 172, 311, 172, 311, 172, 311, 172. So that is basically how we split. We split the equity component and the liability component. Yes. So if you happen to come across this question and you see the word convertible somewhere, it can either be convertible bonds, it can either be convertible debentures, it can either be convertible on stock. So what is important for you to do, to remember, is that that is a compound financial instrument. Being a compound financial instrument, you need to split the two components, the liability component, the equity component. After doing that, we say that the value for this equity component for the next 5 years remain, the value for this equity component for the next 5 years will remain the same. We remain the same. But basically this one, whatever you have computed here as a liability component, this is what our company has to pay in the next 5 years. This to the company is therefore like a loan. So being a loan to the company, automatically what do we need to do to this? This one we need to amortize. We need to amortize this liability. Because like what our company is required to pay in the next 5 years. So what we need to do is we amortize it. So we amortize this by basically preparing the amortization schedule. The way you amortize a loan, the amortization schedule. So here we will have our 5 years. Our 5 years, I think we can have just year 1, year 2, year 3, year 4, year 5. Although this specifically, this is not what the question was requiring. The question was just requiring the candidate to prepare this for just 1 year. That's why you can see you are required to compute the amount or the carrying amount to be included in the statement of financial position in the past year. That's why you can see the question has just 5 marks. Because we said, if, for example, the examiner requires you to prepare financial statement extract for the 5 years, that question should be you should be given at least 8 to 10 marks. 8 to 10 what? To 10 marks. So what we need to do, can we amortize this? I want us to do it for the 5 years so that you understand. So here we will have what? We will have, remember what we are amortizing is the liability. So here we will have the value, the liability at the start of year 1, the liability at the start. The next column here is basically interest, simply because all these amounts, the annual interest and the principal amount, all of them will be paid at the end of the year. How do we compute this one? We compute this using the effective interest rate, which is basically 9%, not 7%. So we don't use the coupon interest rate, we use the effective interest rate. Then here we will have the column for the cash to be paid. And finally, we will have the liability at the end of the year. And even before you record anything, what is, maybe you can start by recording here, is the cash to be paid. Remember, you have seen our company here. In the next 5 years, the company has to pay interest of 280,000 at the end of each year. And then at the end of year 5, the company will also pay 4 million. So therefore, the cash to be paid in year 1 here will be 280,000 to 80,000 in year 2, year 3 to 80,000, year 4 to 80,000. And then now year 5, the company will pay 4 million and 280,000. So 4 million plus 280,000. Then here we need to start with the liability at the start of year 1. Liability at the start of year 1 is what we have here. That is 6, 88, 828. So then from there we need to compute the interest. So the interest we computed based on the rate of 9% times the liability at the start. So we have 9%, this one, times the liability at the start of year 1, which is basically 36, 88, 828. And that will give us interest over 331, 995. So how do we compute the liability at the end of that year? Just similar to what we have done in that question for leases. So we take this one plus the interest minus the cash paid. So this one will be A plus B minus what? Minus C there. Minus SC there. That's that? Yes. So let's work out that one. So we will take this plus this minus this. The cash paid will be deducted because this one reduces the value of the liability. The value of the liability. Okay. So we have 36, 88, 828 plus interest 331, 995 minus 280,000. 280,000. And basically I'm getting 37, 40, 823. So that will be the opening balance in year 2. 37, 40, 823. And I hope, yes, that is confirmed. So we get the interest, 9% of that. So which is the 336,674. Yes, then we compute the liability at the end of year 2. 37, 40, 823 minus 280,000. So I'm getting that here. 837, 497. So that will be the opening balance there. 837, 497. We compute the interest being 9%. Being 9% of that, 38, 37, 497. 9% of that. And I'm getting what? 345, 375. 375. 375, Yes, 375. Rin, you're getting what? That is 797. So meaning that my value is not correct. Someone to confirm whether my value is not correct. It is not correct. It is not correct. Is my figure correct or not? Rin, is my figure correct or not? That is 797. 497. 497, then that will be the opening balance here. That is 797, 497. So what will be the interest? What will be the interest there? What will be the interest? 3797, 497. Very hot. The interest. The interest. 341. 341. 775. Yes. So what about at the end of the year? $38, 59, 272. 272. Okay, that will be the opening balance here. 38, 59, 272. Interest, which is basically 9%. 347. 334. 334. That is basically what I'm getting. What about the liability at the end of the year? 38, 59, 272 minus 280,000. Yes, and I'm getting 926, 606. So that will be the opening balance here. 3926, 606. And then we get 9% of that, which is that correct? Yes, it should be correct. 353, 395. And this one should be 0. That one should be 0. Or basically you get a figure which is not insignificant figure, which is insignificant. Are you getting 0? Are you getting 0? Maybe a figure which is not significant? Yes. So basically that is it. That's how we amortize that. Now, equally, in such a question, what the examiner requires you to do is you prepare financial statements extract. You prepare financial statements extract. And basically the financial statements extract which are required here is number 1, the income statement extract. You show what was supposed to be recognized there. And number 2, statement of a financial position extract. So let's start by preparing this income statement extract. And actually we will prepare this for 5 years. You can have the specific dates when each year was ending. But I think no problem, you can't be penalized for that. So let's have year 1, year 2, year 3, year 4, year 5. So what is supposed to be recognized in the income statement as far as these compound financial instruments are concerned? So what the company should recognize here is this interest. You see, this interest should be recognized here as part of the finance cost. And actually that is an expense. That is an item of expense. Is an item of expense. So here the company will recognize the finance cost. For the first is what we have here, 331,995. For year 2 is this, 336, 674. For year 3 is 341, 775. For year 4 is 347, 334. And basically for year 5 is 353,395. So this what this company was supposed to recognize in the income statement, basically as an expense, the finance or that interest. Anything else? No. So what about in the statement of financial position? In the statement of financial position equally for 5 years. Now here, the company basically recognized, or supposed to recognize how many items? 2 items. Number one, this equity component, this one should be recognized in the statement of financial position as a component of equity. As a component of equity. Remember, when preparing this statement of financial position, we start by recording assets. We record non-current assets, current assets, we record equity, and then liabilities. Do we have any item of asset to be recognized here? No. So the next item we should recognize is equity and finally liabilities. So therefore, we start by showing what was supposed to be recognized under equity. Remember, equity, share capital, and reserves. Now, this equity component, we come here and we say the company was supposed to recognize equity component of this, of 7% convertible bonds. You can write that in full for your revision purpose. Equity component of 7% convertible bonds. Sasa, yes. The value for this, the value for the equity component, remember you say that this one will not change over the next 5 years. Over the period of 5 years, that value does not change. 311,172. 311,172. 311,172. 311,172. 311,172. That amount will not change. That amount will not do what? Will not change. Then, under the liabilities, the company recognized this liability component. This liability component, this one will be recognized here as part of the liability. So basically as part of the non-current liability. So we will say under the non-current liabilities, our company recognized the liability component of 7% convertible bonds. Sasa, liability component of 7% convertible bonds. And basically that is what we have here. This liability component, liability, the value for the liability at the end of each year. At the end of year 1 is basically that 740,823. Year 2 is 79. That is 3779. 497. Year 3 is 3859. 272. Year 4 is 39. 26, 606, and basically year 5 is what? Is 0. Year 5 is what? Is 0. So basically this is what should earn you the marks. But remember what we have said is that if you happen to come across such a question, usually the examiner will have given you around 8 to 10 marks. 8 to 10 marks, because you can see the question is quite what? The question is quite